Good afternoon, ladies and gentlemen. Thank you all for joining us today for today's webinar on the updated EPRA BPR guidelines and BPR survey scoring methodology, What's New? My name is Hassan Sabir, and I'm the Finance and ESG Director here at EPRA. It is my pleasure to welcome a diverse audience dedicated to advancing transparency and best practices within our industry, particularly in non-GAAP financial reporting. The EPRA Best Practices Recommendation, or BPR in short, have long served as a cornerstone for enhancing the consistency, comparability, and transparency of non-GAAP financial reporting amongst listed real estate companies. Today's session will focus on key updates and revisions that ensure our standards continue to align with evolving market needs and best practices. I'm pleased to introduce our speakers who bring expertise and insight to today's discussion. Simon Robson-Brown, Managing Director at Morgan Stanley Investment Management, and Baris Sari, Reporting and Accounting Manager at EPRA. Together, they will guide us through the updates to the guidelines, including changes to EPRA earnings and the rationale behind these revisions, as well as the newly revised scoring methodology for the BPR survey. We will also explore what these changes mean for your reporting processes, offering practical insights and addressing key questions to help you navigate and implement these updates effectively. Without further ado, let's get started. Simon, the floor is yours.
Thank you very much indeed, Hassan. Good afternoon, everybody. Thank you for joining us today. Just by way of introduction, I've been a user and a fan of the EPRA BPR for about 25 years, and in the latter period I've been on the reporting and accounting committee at EPRA, trying to drive through improvements. Well, what I saw as improvements, at least. The focus in recent years has been on the balance sheet, really. It's been on the various NAVs and on the loan to value ratio. There really hasn't been too much focus on the earnings side, and it was becoming increasingly clear that the earnings BPR were getting a little bit left behind. So we've had a lot of debate amongst the committee members to try and bring it up to date and try and make some changes. I'm hoping you won't find them too groundbreaking or too controversial. They really split into two halves. The first half is to do with the capital stack, or how subordinated equity is and the equity earnings are. So the major change there is to bring EPRA earnings in line with the NTA, which is basically to take hybrid bonds into account, or the interest on hybrid bonds into account. So this will have, if you have hybrid bonds, this will have the effect of reducing your EPRA earnings a bit, but hopefully you can see that would be consistent with how the other BPR have evolved. The other part is a little bit more subjective. We were noticing that companies were producing company adjusted EPRA EPS quite often. So there were quite a few adjustments that companies were making because the EPRA rules were quite prescriptive. So there were a few changes coming in where you couldn't just look at the EPRA number, you had to look at the adjusted number. So that's one side of it. The other side of it was sometimes companies weren't making adjustments, and you kind of looked at the numbers and thought, well, why aren't certain things being taken out? Because they're really not recurring. And to give you some examples of that, like big peculiar deferred tax changes where there was a change in the base valuation of an asset, or big material surrender premiums that were staying in earnings per share, or a pension credit. Maybe there's been some change in the accounting of a pension liability, and then there's a credit that's come through the income statement. These are real examples that have had big chunky effects being left in the EPRA EPS, because that was the rule. I'm not saying the companies were doing it wrong. It's just that the prescriptive nature of the earnings per share metric didn't allow it to be reversed. And if you didn't adjust it and have an adjusted version, then it was left in. So net, the numbers weren't being very comparable. So what we're proposing, or what is occurring, is we're making it easier for companies to make those adjustments. And it's up to the companies to decide what is properly recurring and what isn't, and to make those adjustments. And then that is what we're going to be calling EPRA EPS. So those are basically the two pillars, capital stack and adjustments, of what we're trying to do. With that, I'll hand over to Baris to talk you through some of the detail.
Thank you, Simon, and welcome everyone to this second webinar. Maybe to start off, I will maybe give you a little bit of background on the process. So as you may know already, EPRA has different committees on the different departments it has, and in the reporting and accounting committee, we discuss about anything that can impact the listed real estate market and also our membership in general. As you can see on the screen, the committee is composed of property companies, Big Fours, investors, and also our counterpart, EPRA counterpart in the US and in Canada, so NAREIT and REALPAC. And we also discussed during those committee meetings, the BPRs, obviously, how appropriate they are throughout the years, their performance, etc. And it has been raised last year that, like Simon mentioned, that the EPRA earnings might need some update. So this is what we did. We created a subgroup, a subcommittee meeting with committee members to discuss about the EPRA earnings and to only to be discussing the EPRA earnings. So we had the first meeting on the 2nd of November. Then, as you can see on the screen, we had different ones in December, March. And throughout all these meetings, we have been discussing every adjustment, every almost annual reports to make sure we provide the most complete version on the 13th of June, and finally release in October. Just to give you an order of ideas, during all this process, we have 26 different versions, which can maybe help you to understand how serious every individual contributed to the changes. Then on the next slide, so this is a screenshot of the updated guidelines, which, by the way, you can find in the resource tab of this webinar. And as you can see highlighted, we have two adjustments, or should I say maybe two sets of adjustments. The first one, maybe we can go to the next slide already. The first set of adjustments relate to the funding structure. So we have two different items. The first one, hybrid interest. So as Simon mentioned, also to mirror and align with what we did on the LTV, interest payments related to hybrid will be deducted from the EPRA earnings. And the second one is preferred shares, D-shared, and private preferred equity. All form of compensation paid to holders of those shares had to be deducted as well from the EPRA earnings. Then we have a second set of items, non-operating and exceptional items. The first one, unusual item. So what is an unusual item according to EPRA is items that are unusual in nature and very unlikely to reoccur in the foreseeable future. As you will see, so we are still on the left-hand side of the screen, and we have a list, which is a list of examples we took out directly from annual report. So we went through our members' annual report, we checked this company-specific adjustment, and we tried to understand which ones made sense to become original. So this list is really specific and non-exhaustive. So as Simon mentioned, we have unusual and significant surrender premium, or one of different tax adjustments, and the list is there. Other items in this set of adjustment, we have also foreign FX transaction cost. So they will have to be deducted as well. Here it's important to precise that we are still under the non-operating and exceptional items. Another very specific adjustment we have changed to fair value of contingent consideration that will have to be eliminated as well. This to ensure that the EPRA EPS is reflective of the company's operational activity. We have then in D, impairment of equity interest that are considered in the calculation of the EPS as well by reversing the effect of the impairment. In E, we have depreciation and amortization of non-real estate investments. So here we mainly refer to solar panels that if they are accounted for at cost, the depreciation will have to be stripped out. And then if under IAS 16, we decide to use the revaluation model, then the asset will be carried at a revalued amount, which is the fair value, less subsequent depreciation. And this is that amount that we want to strip out as well from the EPRA earnings. We have also, just to let you know, an FAQ with questions on those adjustments and answers that we prepared, so we can share that also later on in case you need more information on each of these adjustments. And finally, we have IFRS 5, where the operating income of an asset held for sale is offset against the profit of the sale or loss of the sale. It should be included in the EPRA earnings. So that's it for the adjustments we added on the EPRA earnings. On the next slide, the question that comes the most is when will these new guidelines and new EPRA earnings will be effective? So you will find in the guideline this sentence, the guidelines will be applicable for the next annual reporting period, starting after the release of this guideline, which is October this year. So what it means exactly, then you can check the table below. So most of the companies will have a December year end. And for those companies, the guidelines will be applicable for 31st December 2025. So that's for next year reporting, and therefore for the year after, so 2026, survey assessment with Deloitte. And then you'll see the second and third column for year end on September and March. That will be September 26 and March 26, and therefore for the next survey report. This being said, we also strongly encourage companies to already include those changes in their report because, as we already said, most of them are not applicable, and I think it would be easy to just comply already. Yeah, I think we can go to the next slides. We have a question also on the EPRA earnings per share calculation. We did a small change as well. You will see on the first page of the EPRA earnings. We emphasize that for the calculation of the EPS, the basic average number of shares has to be considered, which for some companies sometimes wasn't the case. Next question on the surrender premium. We understand that it may be perceived sometimes as a bit too much open to interpretation, sorry. But what we want to highlight here is that we're looking at very specific surrender premiums that are considered unusual and unlikely to reoccur for your operational activities. The premiums that are consistent in frequency and amount are not referring here. Finally, what is considered an unusual item under this new adjustment? So I just explained it actually a little bit before, but it's also important that as part of this adjustment to be compliant, we want companies to disclose the breakdown of the different items included in this adjustment. This will help any FS reader, investor, or anyone going through your annual report to understand exactly what's included in this adjustment. And this is one of the driving line of the BPRs, but EPRA in general, where we try to promote transparency and comparability between companies. So yeah. And yeah, I think we will pause here a little bit for questions if and we can check, I think, in the chat. If you have questions, please don't hesitate to type them in the Q&A tab. So we have one question. You define unusual and significant and one-off. If you receive a performance fee every 5 years, it is not one-off, but does distort the profit in those years. Assuming this is not consistent, then I understand we can adjust this, like with surrender premium. Performance fee every 5 years. Yeah, that's a very good question, Lawrence. To be honest, I don't have the answer right now. I don't know if Simon, you have a preliminary answer on this one.
Yeah, I can have a go, Barris. To the extent that a performance fee has come from capital performance, I would be minded to exclude it. If it's come purely from operational performance, then I might include it. I suspect you need to have a capital performance to get a big performance fee. So I suspect the default should be that you exclude it. But that would be the thinking I would try and come to. Has this performance fee come from capital or income? And adjust accordingly.
It comes from capital, apparently, as we received information live.
Okay, so what we're trying to get to is an operational recurring income. I think by definition, if your promotes performance fees coming from capital, it's not a recurring thing.
Perfect. We have another question to Simon. I can read it out loud. Did you get a lot of discussion and different position regarding the treatment of the interest in the EPS?
From hybrids, presumably.
Yes, I think so.
The answer is no, not very much. I think that battle was fought with the LTV and NTA. And there are some big companies out there that were already adjusting for it in their company adjusted number. So that wasn't a big issue, I think it's fair to say.
Maybe it's important to note as well, if you have questions afterwards, it's not too late. You can still reach out to us, our personal email address, or to the Randa email address. Maybe we can put it in the chat so you have the email address you can reach out. And I see no more questions, so I think we can go to the second part of this webinar, which relates to the scoring methodology. So this is another change we did this year, how we assess companies. Maybe also important to highlight that this assessment has of primary objective to ensure the compliance of our member. So on the first slide, you will see 3 different changes, but there is one we sometimes forget is the inclusion of the EPRA LTV, so it makes sense, but now the LTV is part of the BPR, so it's part of the assessment as well. The first item we decided to update are the requirements to be a Silver Award member. So we updated from minimum 60% scoring and 3 BPRs to minimum 60% and 5 BPR, which will increase the compliance in terms of being a little bit more strict. But comparing to bronze and gold, we thought it made sense as a group. The second point, there is nothing to worry here. It's just a change of name. So we took the like-for-like rental growth and the CapEx disclosure, and we decided to rename them BPRs, as they usually were referred to as other recommendation, I think, core recommendation. Now all the BPRs are called BPRs. But the compliance here doesn't change, the scoring doesn't change. So this is just a change of name. And the final change is the zero line items. So before we have companies for which most of the adjustments were not applicable. So you will have a table on an A4 page that would be maybe 2 lines with 2 different items, and the rest of the table will be 0 line items. And because we also try to increase the annual report in general and the disclosure, we decided that companies can remove those line items and have only the applicable transaction in the table. On the next slide, you have also the scoring allocation that has been updated. You can see the total score is now on 100. Before it was on 48, 47.9. So to make it clearer for everyone, we decided to make it to 100. So you'll see every BPR and the respective weight. This table is also included in the document, the scoring methodology document that's on our website. So you will find the exact same table. And then we have also prepared some questions and answers that we already received since 1st of October, the day we released those guidelines and scoring methodology. So in this case, when will it be effective? The new methodology is effective already for next year. So that means what it means. Companies with December year end, we are already taking December 24 into consideration for this new methodology. Regarding the zero scoring policy, does it include the EPS? Yes, so the zero scoring policy is one of the main policy we have in the scoring methodology. If you don't disclose the underlying calculation of a BPR, no point will be granted for that BPR. We haven't been that strict in the past regarding this policy, but now we will. And regarding the EPRA earnings per share, the calculation is basically just the EPRA earnings, the shares, the EPRA earnings per share. So we just want to see the number of shares and basic average number of shares disclosed in your annual report as well. And finally, zero line items, what is it referring to exactly and why should we remove them? This is just for clarity. We understand now that annual reports are getting bigger and bigger, even with ESG disclosure. We want to make sure we don't duplicate information and we don't add a line that is equal to 0 because it's confusing anyone. So for that reason, we want to keep it concise and remove an adjustment that is not applicable for your company in terms of disclosure. Another important thing to note here is that we would like to see, so the only condition is like we would like to see statement explaining why those adjustments have been removed from the table. It's not because you didn't want to show that you have that much hybrids, but just because you don't have hybrids. You just didn't disclose them. And I think that will be it for the second part of the webinar. I don't see any questions.
Yeah, thank you, Boris and Simon, for the insights. So I think somebody's raised a hand from the attendee side, but I'm afraid this is a one-way webinar, so we're not able to include attendees as a live participant. But if you use the Q&A option, which you should be able to see on the bottom of your Zoom screen, you can write the question through.
I see a question. Will companies be penalized for removing zero line items if adopted in 2024 reporting? No. So this is this can be done already as we want to see it. So you will not be penalized, of course.
As long as that statement is provided.
Yes, correct. As long as the only condition, which is the statement, is provided under the table. Perfect. I think we can wrap it up here. Thank you everyone for joining this webinar. As we already mentioned, please don't hesitate to reach out to us for any subsequent thought and question you might have on those. And thank you for your commitment on the BPRs in general.
Great. Thank you, everyone.